given that you're saying you should stay engaged with risk on equity trades, do you think there's any shift in that hiking cycle?
Well, I think the big shift that we have seen is that the likelihood that the Federal Reserve is going to come out with a big interest rate hiking by 50 basis points is now much lower. So the Fed is going to be a bit more cautious about being aggressive in its interest rate hikes. But the overall path, we think, is still likely to be similar because, of course, the Fed needs to balance the risks to inflation, which have probably increased as a result of the conflict in Ukraine, with obviously some concerns about uncertainty for businesses and consumers and risks to grow. So we think that they're broadly going to keep the path unchanged for now and only shift if they start to see hard evidence of changes to the growth outlook or to the inflation outlook.
It's interesting you say that, given looking through some of the analysis this morning, many have attributed the stabilization, the bounce back in equities over the last 24 hours to the collapse in 10-year real rates. To what extent do you think that narrative holds up?
Well, I think you've got two dynamics happening in the bond markets. The one end, you think about what is the Fed going to be doing in the short term over the next year or two, and we think that path is broadly unchanged. On the other hand, you've got a lot of investors seeking safety, stability, trying to invest perhaps in the US dollar where they can get more stability, and that's having the effect of pushing down some of those longer term interest rates and real yields especially. So I think that both narratives can be consistent, that we have a rate hiking cycle, but perhaps you see lower long-term yields, and of course that is supportive for equity valuations and the technology sector in particular.
Looking at the financial sector, it's been the source of great volatility, selling off quite sharply in the last 48 hours or so. I see you're bullish on financials, but if we do see central banks turn more cautious when it comes to tightening, surely that's a headwind for the banking sector. Talk us through your bull case and what you would be doing with financials here.
Yeah, certainly. I think that a big part of the positive story on financials is the idea that we start to see these interest rate hikes coming through, and that allows banks to earn more on their deposits and higher net interest margins. So I think that that is clearly a very important part of the bull story. And we actually recently downgraded Eurozone financials, and they are probably a bit more exposed to what's happening in Russia from an economic perspective. And so that leaves our focus more on the US financials, where we think that the rate hike cycle, as I mentioned, is still in place. You're still going to see those rate hikes coming through. That's going to help the banks earn higher net interest margins. And at the same time, we think that they are somewhat more insulated from the events in Ukraine.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.